Well, again, welcome to today's webinar providing some analysis on the Opportunity Zones Transparency Extension and Improvement Act that was introduced last week. Really pleased to see the level of interest in this new legislation and in this webinar and conversation. So thanks again for joining. Just a few housekeeping notes at the top here before we get started. This webinar is being recorded. We will post a recording as well as slides and a recap of the webinar shortly after today's presentation. We'll also circulate that to all registrants and attendees as well. So you should get that shortly. We are happy to take your questions throughout the presentation. So please use the Q&A box to submit your questions throughout the presentation. It's just a little easier for us to make sure that we track them and get to as many questions as we can. So thanks again for using that function. I'm really pleased to be joined by Rachel Reilly of Aces and Archers. She is our partner in crime here for our OZ webinar series, and glad to have her back for this special webinar. We're also joined by Alex Flachsbart of Opportunity Alabama and Stephanie Copeland of 4 Points Funding. Thank you both for making time to join us for our discussion, as well as Adam Ferris, Senior Policy Advisor for Senator Tim Scott, one of the lead co-sponsors for this legislation. So at the very end, we'll do some Q&A where you can ask any of us questions, but Adam will be on as well to help provide some answers to some of the questions on the legislation, as well as a potential congressional action and a path forward for this legislation. All right, we can go to the next slide. So I already previewed this a little bit, but in terms of our agenda for today's webinar, we'll start off with a few resources on the legislation itself and provide links to those in the chat. We'll also then go through the provisions of the legislation in more detail, then have a panel discussion with Stephanie and Alex on the potential impact of the legislative proposals on the emerging OZ ecosystem. And finally, as I mentioned, we'll have a Q&A on the legislation and congressional action with all of us, but also with including Adam from Senator Scott's office. Next slide. All right, so for resources on the legislation, we thought we'd just provide right up front some links that I believe Rachel will be putting in the chat for all attendees, a one-page summary of the legislation, a section-by-section summary of the legislation, which goes into a lot more detail on each section and each provision included. Also the full bill text, as well as the congressional press release, which includes quotes from the 5 senators who supported this legislation. I believe there is also a House press release, which we can send out in kind of future materials that includes the 5 co-sponsors on the House side too. So this was introduced with a total of 10 co-sponsors. I can list those off in a few minutes here, but really excited to see that level of support early on for introduction. And finally, EIG's press release applauding the effort and in support of this legislation is included there as well. Finally, as we normally share on our webinars, we also have some fact sheets. I think very appropriately, we have our proposed legislative improvements, many of which are included in this legislation, which is really great to see. And we also have a fact sheet of investment activity that we've been tracking over the course of the policy's early life thus far, as well as socioeconomic characteristics of the Opportunity Zones communities. All right. So an overview of the legislation. So this legislation, the Opportunity Zones Transparency and Extension and Improvement Act, it was introduced last week on Thursday by Senators Booker and Scott. So the senators that were leading this effort initially starting in 2016 and have continued to champion this policy. They led this effort as well in the Senate. They were joined by Senators Warner, Van Hollen, and Young in supporting this. in the House, Representatives Kind, and who was an original lead of the Investing in Opportunity Act on the House side, which was the original legislative vehicle for opportunity zones. So he introduced this with Representative Kelly, representing Erie, Pennsylvania. If any of you are veterans of our webinar series, you know very well about some of the successes Erie has had with opportunity zones. They were also joined by Representative Sewell of Alabama, another longtime champion of the policy, as well as Representative Jackie Walorski of Indiana, and Dan Kildee of Michigan. So the provisions included in the legislation are reporting and community measurement requirements. This has long been a priority of stakeholders across the market and congressional leaders. There's long been a recognition of the need for reporting, and so this would accomplish that goal by including the Impact Act that was introduced originally by Senator Scott and a group of bipartisan co-sponsors in 2019. I'll get into all of this in more detail momentarily, but I'll move on to the early sunsetting of opportunity zones with a high median family income. There's a very small percentage of the overall map of tracts that have a higher median family income and were designated as opportunity zones. This would sunset those tracts and allow governors or state executives to replace those in equal number with high need communities. It would also extend the deadline for investment from the end of 2026 to the end of 2028. Again, a kind of policy that has been long championed by the market, as well as Senator Scott especially has worked on this for quite some time. So this would include that change. It would allow for fund-of-fund investments, and I'm definitely excited to talk a little bit more about this with both Stephanie and Alex too. I think that this would really help work, especially in more regionally focused, kind of smaller and high impact funds, in terms of sourcing and finding capital for those funds and their impactful work. It would designate certain formerly zero population industrial brownfield tracts as opportunity zones, so kind of narrowly expanding the use case of the policy in that way. And finally, it would create a federal fund for state and local community resources, and we'll get into a lot more of the targeted communities there and the potential use cases that would be allowed for that $1 billion fund. Let's go to the next slide. All right, so we'll start with reporting and community measurement requirements. As many of you probably know, the original Investing in Opportunity Act included reporting requirements, but the way in which it was passed through the reconciliation process at the end of 2017 in the tax reform bill, that was taken out just for procedural rules, essentially. And so it was always the intent of the congressional sponsors to have reporting included, in this for this policy. But because it was taken out, that this has also been a source of kind of critique around opportunity zones. It's also just important for general best practice. We want to know what's happening across the country, because of this policy, and this would allow for the collection of important information that would help us get a much better and more complete picture of what's happening across the country because of OZs. So again, as I mentioned earlier, this includes the Impact Act, which was introduced by Senator Tim Scott and a bipartisan group of senators in December of 2019. Essentially what the Impact does is it codifies and expands on Form 8996, which is for qualified opportunity funds. It then also codifies and expands on Form 8997 for investors in QOFs. It requires Treasury to publish an annual report of the aggregated information reported by QOFs and investors, and that includes the number of funds, total assets, distribution of investments by industry, location of investments by census tracts, the kind of proportion of investments in real property versus business equity, so getting a better sense of real estate versus business investments, where applicable, number of residential units created, as well as kind of businesses by firm size that received investment. So again, I think it's important to note that this would all be aggregated information by census tract where that's possible. And we think that that is important to the protection of both potential competitive information, as well as, of course, personally identifiable information. It's also just kind of general practice by Treasury to release information in that way. So the annual report would, again, include aggregated information that would give us a clear picture year by year of what is happening in designated census tracts and what are opportunity zones investments helping to really to catalyze in terms of the projects in these designated zones. So that would be a huge help. Obviously, right now we have incomplete or sort of partial data from either only electronic tax filings or only from the earliest year of the policy before regulations were even promulgated. So we have a snapshot, but an incomplete one, and this would help provide for a much clearer and complete picture of what's going on. Finally, and I think also very importantly, it would require Treasury to examine the socioeconomic outcomes of designated tracts as compared to non-designated low-income communities. So kind of using that almost as a control group, taking a look at how are outcomes different for opportunity zones versus tracts that would have been eligible but were not chosen. And those reports would be issued in kind of the 6th and the 11th year after enactment. So really trying to take much more of a longitudinal look at the overall outcomes over time of these places. And the last thing I'll mention on the reporting piece is that it will also create a penalty regime for both opportunity funds and investors as well. On the early sunset of opportunity zones with high MFI. So as I mentioned, in general, opportunity zones are low income, high need communities. And this was validated and confirmed by the GAO report released last year on the policy. A very small percentage of tracts, however, were designated by governors and certified by Treasury that have an MFI, a median family income, that either is at or exceeds 130% of the national MFI. This legislation would target those tracts, and it would early sunset opportunity zones with an MFI that exceeds that threshold. There would be an exception made for high MFI OZs that also have a non-student poverty rate of greater than 30%. It lays out a process as well by which state executives would be able to replace, of course, those disqualified tracts with an equal number of high need communities. So from this provision, the overall number of tracts would not change. Again, state executives would have the opportunity to, consult with local jurisdictions and determine the best tracts that are qualified, again, low-income communities, to replace the number of zones that would be disqualified. It also lays out a process by which state executives could either nominate additional tracts to early sunset. I think the intention here is that we know that some states either made mistakes in their designations. We've heard of examples such as graveyards or battlefields or swamplands that were designated that have no opportunity for investment and therefore are kind of inconsistent with the intent of the policy. So governors would be able to nominate those types of tracts for disqualification and replacement as well. They would also be able to appeal if they feel strongly that a certain high MFI tract, OZ, is imperative to their economic development strategy, or want to make the case to Treasury that it should retain its OZ designation. They can do that, and Treasury would have to agree. They would have to kind of take that case and agree with them in order for that tract to remain. It also provides some rules for pre-existing investments in disqualified tracts. So there's, of course, an understanding that if investments that have been made in these tracts already should be allowed to continue, they are operating under the current rules of the road, and should not be penalized, for these tracts, for operating in these tracts that would be disqualified. And so the legislation aims to, protect those tracts while also taking care to not allow for kind of new activity or new investments to be made in these places. So I can go into a little bit more detail on those, but for the maybe in the Q&A, I'll do that just for the sake of time. But I know that that's something that is probably of interest. And so happy to go into a little bit more detail about that. I think there was a question that I may have seen in the chat here about, what tracks, do we know which tracks these would be yet? We want to use the latest available data. I think that's been another issue, is that tracks were often designated using kind of data from 2015, 2016. So I think there was a real desire to make sure that the tracks that we're looking at here are disqualified according to latest available data. Now, there's a challenge there in that 2020 data has not yet been kind of applied to the existing OZ boundaries, which are set using the last census. So unfortunately, there's not yet a clear picture of the total number of tracks that would be, that would exceed this MFI threshold according to the latest available data. But that's something that I know the co-sponsors have worked closely with Treasury on kind of consulting them related to that. But I think there's there's a desire again to kind of make sure that we're using the latest available information. But what that also means is that it's not possible, at least at this moment, to take a look at the map and identify exactly which of these tracks would be, would meet some of this criteria. Go to the next slide. So pretty straightforward, the extension of the deadline for investment. So as many folks know, the legislation, or there's a deadline to make OZ investments, and to the deferral date essentially by which your taxes will come due is December 31st, 2026. Currently, this would extend that out 2 years. Essentially, I think the thinking there, or the kind of intent behind that, is that it took Treasury about 2 years to issue final regulations, during which many folks, communities and investors included, felt like they needed to sort of remain on the sidelines until they felt they had true clarity on how to operate, within the kind of boundaries of the law and the regulations. And so, this would essentially recoup that time lost. It is a perishable incentive, and so we recoup that time lost for regulatory implementation. It would also, really, we're hopefully entering kind of an economic recovery here coming out of the pandemic. And this would, help this tool be even more effective, I think, in the wake of the pandemic, as communities that have been hard hit by COVID and are also opportunity zones. The Venn diagram there is quite overlapping. And this would be, it would make it even more powerful tool, for those communities. It would also lower the requirement to receive the additional 5% step up in basis from holding the investment for 7 years to 6 years. So if this were to pass before the end of this year, investors would have before the end of 2022, essentially, to receive that the full suite of benefits, essentially, so that 15% step up in basis. You can go to the next slide. So it would also allow fund-of-fund investment. So essentially, this would modify the definition of an opportunity fund to be organized as a feeder fund that may invest in other opportunity funds, but so long as there is only one quaff-to-quaff transaction. So essentially what that means is the feeder fund could invest in another opportunity fund, but then that opportunity fund would need to deploy the capital into qualifying investments. A feeder fund would be required to be formed as a partnership and invest at least 95% of its assets into a qualified opportunity fund. And essentially, again, the thinking behind here is that it would allow smaller, regionally focused, impact-oriented funds to raise capital and overcome some of the scale challenges that we've heard exist with some institutional investors. And I think we can get into a little bit more of this with our conversation with Stephanie and Alex as well. On the next slide. All right, so this also includes the Rust to Revitalization Act. This was legislation that was introduced last month by Representative Kildee and Rippersberger of Michigan and Maryland, respectively. This provision would allow for certain zero population census tracts that are adjacent to an opportunity zone, formerly industrial, and contain a brownfield site to be designated as opportunity zones. And it sets forth a kind of process that is parallel to the initial designation process. State executives would be responsible for nominating these tracts, and then Treasury would need to certify them, ensuring that they meet all the criteria laid out in the legislation. The thinking here is that, and especially Representative Kildee has been kind of a long time advocate for this. He has a pretty massive tract in his district in Flint, where a former Buick City factory. It is totally vacant. Nobody's living there. Formerly industrial brownfield could be an anchor of economic activity, has immense possibility, and yet was not able to be as designated as an OZ because it's zero population and therefore does not meet the kind of low income, and you can't meet those low income kind of thresholds or requirements with zero population. And so it would kind of narrowly expand the use case, for this policy, but in a way that we feel, I think is consistent with its intent, which is to, revitalize these places, traditionally that have had a really hard time, finding financing to rehabilitate brownfield sites, and hopefully increase their potential to really be those centers of economic activity for these communities. Next slide. And finally, this would establish a state and community dynamism fund. So this would establish a $1 billion fund that would need to be appropriated and go through that process. The fund would allocate money to states using a formula based on the state's prime age adults not employed as compared to the national figure. States would then be able to sub-allocate the funding to local communities and nonprofits. The targeting here would be, high poverty, high need, rural, underbanked communities, investing in minority women and veteran-owned businesses, advancing workforce development strategies for strategic sectors for those states' economy, and creating additional affordable housing. The use cases are pretty varied and flexible. They include, capacity building, coordination, technical assistance, professional service firms for underserved either opportunity fund managers or businesses, thinking, for example, of best practices deployed in like Baltimore or Colorado, as Stephanie can talk to, or Alabama, as Alex can speak to, having that kind of coordinating role, that real technical assistance at the community and the state level can be really, really helpful and effective in attracting capital and preparing communities to receive that capital in a way that is consistent, with their goals and that benefits their residents. So that's kind of what we would like to see happen at scale, and hope that this fund can help achieve that. It would also potentially be eligible for pre-development costs associated with OZ projects that are high impact, risk mitigation for opportunity funds, and these, specifically operating in sort of higher need industries like healthcare, social services, healthy food access. Another use case not listed here would be additional affordable housing, or investment in small businesses as well. Next slide. Great. So you've heard me talk quite a bit, and now I will turn this over to Rachel to moderate our discussion with Stephanie and Alex on what are the kind of real world potential implications of this legislation on the market, on the ecosystem. And then I'll come back for the last part. We talk, kind of sift through some of your Q&A that I've been seeing come through the chat and the Q&A box, and we'll bring Adam in for that as well.
Yeah, thanks so much, Catherine. And what an exciting time to have a new piece of legislation to advocate for and rally our support behind. I know that it was a result of, years of feedback from a wide variety of stakeholders. So it's really exciting. And thanks to everyone who joined us today. So as Catherine just went through and did a really great job of providing an overview of the key provisions, we also wanted to have a conversation around how the real world impacts of these provisions, how this will actually affect fund managers, investors, community stakeholders, and others that are involved in the opportunity zone industry or ecosystem, however you view it. And I cannot imagine two better people, or there's a handful of people that we would love to talk with, but I am so excited to have Alex and Stephanie join us. So without further ado, what I'm going to ask them to do is Alex Flachsbart from Opportunity Alabama and Stephanie Copeland from 4 Points Funding, just to introduce themselves, talk a little bit about their engagement with Opportunity Zones to date, and then, do just a high level, what is your initial take of this bill? And are there any specific provisions that really stick out as being meaningful or having a high level of impact on the Opportunity Zones policy and stakeholders? And
Happy
Alex,
to.
yeah, you're not muted, so I'll hand it over to you.
Stephanie and I may or may not have been messaging each other separately on who could jump in first. So I'm just going to bite the bullet and do it. Hi, folks. Alex Flachsbart, founder and CEO of Opportunity Alabama. Great to talk to you today. To Rachel's point, I think that there are literally dozens, if not hundreds of us who, when we saw this drop last week, were sat up, jumped out of our chairs and did a little dance because we've been waiting for this for so long. And it's exactly the people that I think, Rachel, you alluded to, the people that have been working in this space, trying to till soil, to plant seeds of revitalization in communities across the U.S. And so super happy to kind of be here having this conversation after 3 years of build up around it. So I run Opportunity Alabama, which is a 501c3 organization specifically focused on economic development in distressed communities across the state of Alabama. We start with Opportunity Zones. That's our primary focus, and it's where most of the work we've done to date has occurred. We have two sides of our organization. One is a capacity building side, where we work directly with community members, local developers, and local investors to tee up potential projects. We provide technical assistance and then introductions to our Access to Capital network to get those deals stood up. We do a lot of work in rural communities, for example, trying to identify projects that could receive OZ investment, and then technical assistance on twinning that investment with all the other things you need to make it work, like historic tax credits, new markets tax credits, state and local subsidy, et cetera. Which, by the way, is why I'm so excited about this dynamism fund, which we can get to later. The other side of the house, we have over the last couple of years actually raised our own opportunity fund that we're selectively investing into some of the projects that we think have the highest community impact potential and also the strongest potential for market rate returns. We've got about 19 million in a vehicle that we're currently deploying to OZ deals across the state, and that we have about half of that currently invested and are investing the other half this year. So it's been fun to build this infrastructure out. None of it would have been possible without Opportunity Zones, and I think that the contents of this legislation will help deepen that work significantly. So I have lots of other fun things to add, but I've talked enough. So Stephanie, you want to do your piece?
Sure. Thanks, everyone. Nice to see some people here. Stephanie Copeland, I'm the managing partner of 4 Points Funding. We're about a 3.5-year-old Opportunity Zone fund. We've just opened and raising our fourth fund. We're about $150 million, investing strictly in the greater Colorado area, based on the thesis of population growth in the area. And we've really focused on rural areas, not as much as you would think of inner city distress, but in kind of broader community distress, that these markets have a hard time attracting capital because of their size, not necessarily the nascent value. And so we've worked hard to put together a very strong team. We're developing about 1 million square feet of housing. About 1,200 units right now are under development, fully funded, entitled, and on the way. And it has been 3 years of pushing a boulder up a hill to get some momentum going. So the announcement of this legislation was both heartening for me because, as we mentioned, as we all kind of talked about earlier, it takes some time to build the market. And now that the market is kind of accepting that these are plausible investment vehicles, really showing them how to make this work is coming to life, and having more time is fantastic. We've also seen lots of different things that have occurred with regard to fundraising and deployment that this bill will address, which we're really excited about. This is not perfect legislation, as Catherine mentioned earlier, and neither was the original legislation, but I think it is it's really doing things like catalyzing investors like Alex and like myself. I'm not a 501c3, we're a market-based opportunity zone fund, but we're trying to be as catalytic as possible and align this with the intent of the bill. So thanks for having us, Rachel and Catherine, and look forward to just discussing more.
Yeah, thank you, Alex and Stephanie. So I guess maybe we'll just start right at the top. Alex said he was very excited to talk about the Dynamism Fund. So maybe that's where we'll start. You know, how can the funding from the Dynamism Fund really help to support community aligned deals, investments in real estate, as well as businesses? I'd love to hear your take, Alex and Stephanie, on that specific issue.
So it's been so interesting to watch the last 3 years of evolution in, to Stephanie's point, kind of the pipeline development space. So we've, on the technical assistance and consulting side, the nonprofit side of the house, have catalyzed about, like, I'll call it 350 million plus worth of deals where we did TA or we were able to connect partners. And I can tell you that number, a lot of that number is in urban geographies, like Huntsville and Birmingham, where you've got established markets and where you've got opportunity zones that can, where you've got investors that were already relatively plugged into understanding what a market like that could look like, right? Livingston, Alabama is a very different story, right? Heck, even Florence, Alabama, or to some people, Mobile or Montgomery. I'm listing huge cities in Alabama that many of you probably have never heard of, right? And even so doing any degree of capacity building in those places and trying to make a market in those places, to Stephanie's point, it just takes time, and it takes very concerted focus and energy and attention, and it also takes human capital. And the question, I think, for a lot of states that just didn't have an organization like Stephanie's spring up, an organization like ours spring up, has been, how do we catalyze growth in the places where you don't already have some degree of market activity happening? And it's human capital is what it always comes back to. The fact that there is now resourcing for states to bring human capital, pre-development assistance, technical assistance to get pipeline started is, it's a total sea change, right? Because especially if you look at the current grant landscape, there are so few federal grants that will fund capacity building work in general, right? So when you think about the creative applications that's just on the human side, right, the technical assistance side, it's huge. You translate that then over to the incredibly creative stuff that people like Jonathan Tower, Ross Baird, like, heck, Stephanie, right? Like that the fund managers are doing on the fund management side, with first loss capital, for example, with deal level support that can wind up turning a deal that barely pencils or doesn't quite pencil into a deal that does pencil. Having dollars for that as part of a pool is equally impactful in getting those deals that are actually teed up through that technical assistance work across the finish line, right? So I just see the devil will be in the details on the Dynamism Fund, right? On what Treasury is going to allow, on how states wind up applying it. But I think that there is not another vehicle currently that I can think of across the span of just kind of federal investment policy, grants, direct investment, et cetera, that comes close to this, right? So I'm excited about what could be, right? What do you think, Stephanie?
Yeah, I was just going to say, I think we do so much of this just as part of our due diligence process on projects. We do so much work. For example, last night I had a city council approval after a year and a half going through entitlements. I spent close to $1 million completely at risk before I even had the property entitled to build. And that kind of risk capital is hard enough for people to put in place in markets that they have strong conviction around. It's even harder in markets where the conviction isn't as strong, but they would do it opportunistically. And so I think that having a technical assistance fund will be ideal. The devil will be in the details, and putting too many constraints around it will kill it. So I think it's going to have to really come in and incent more people to bet on the higher risk places. And that's I think the key to getting capital into these areas. Now, whether that will eventually benefit the residents of that community, theoretically it will, and trickle down, which is not, as pure as the intent would be, but starting there is the right place, then ensuring that the existing residents of that particular census tract or neighborhood are benefiting will be the follow-on activity that I think is also should be part of this technical assistance.
Yeah, I absolutely agree with both of you. And I do think that having pre-development funding as part of an eligible use of this fund is so important. It's one of the big critiques of recent bills that passed last year, just as far as this is great, but really what we need is pre-development funding to get these projects underway. And just to remind folks, the mechanism by which this money would be transferred, federally appropriated and then moved to the states for the states to develop their own distribution plans. So you have local control of the funds and how it's spent, and they could be tailored to meet local needs, which I think is really smart as well. So going to kind of that question of community input and community support, one of the things that Catherine mentioned is that if there's sunsetting of certain zones, then new zones could be designated by governors. And it goes to one of the questions in here that was a very hyper local question about how do we get the north side of Broad Street and Water in Selma, Alabama designated, right? But zooming out a little bit, how can community leaders best position themselves to have a say in the designation process if new zones are to be designated moving forward?
Well, obviously, you got to keep coming to EIG's webinars, right? That's the first thing. No, Catherine did not pay me to say that. All seriousness, staying informed. I mean, that's the first thing that everyone from here on out needs to do with this legislation. It's making sure that you're tracking this, sign up for the kind of the notices that you can get from federal bill tracking service to let you know kind of how it's progressing through Congress. I saw a question in the chat about when you should be reaching out to people in DC, and I think that the answer to that is always keep an open relationship, especially if you're someone who this could impact, right? Like, I think it's a two-way conversation between you and your representatives around what you're seeing locally and kind of what you hope to see in this piece of legislation. But I think more importantly, if and when, and hopefully Catherine can give us insight on this as to when this could go through, then I think it's constant dialogue with the folks that appointed the zones in the first place and going to your same state government officials that were part of this process 3.5 years ago and saying, okay, this is coming down the pike, guys, making sure that they're also aware that this is coming down the pike. I've already had a couple of conversations with folks in Montgomery about this potential legislation, and I know that we in Montgomery are going to be tracking this very closely, so that there is a process that there will be someone ready and waiting to catch this and create a mechanism for additional community input the second time around, right? But that's, I don't know, I think that's the biggest piece is staying informed and staying on top of your messaging. I'm actually, and I'd be curious to get Stephanie's take on this, from a community engagement perspective. I'll be curious to see how the reporting requirements wind up driving data, influencing decision-making. As a fund manager, Stephanie, how do you feel about the reporting requirements that you're gonna now have to be subject to?
Yeah, I'll definitely answer that. And the answer is no big deal. Like it is what it is. And we do a lot. We audit every year anyway. We're going through detailed issues. We do so much work on community benefits already that it's not a big deal. And single asset funds should not be worried about this either, because it's just answer the questions and move on. The question on engaging the local, preparing and engaging the local, to the extent you live in a state where you've got an opportunity zone office or a state coordinator, definitely get in touch with them and make sure that they understand which tracks do you think were missed. If you are in that position. The second thing is getting really productive conversations are going to happen once we understand which tracks are going to be potentially sunset and how many there are, because the last thing we want to do is spin people up and have in one state only 2 tracks that can be designated because only 2 have been sunset. So there's only so much work that can be done prior to that. But I think going back to the state and local officials that do the designation is really relevant, and finding out who they are is really, really important. If you're in Colorado, just FYI, that's Colorado Office of Economic Development and International Trade, and they have an opportunity zone office, Mike Landis. That would be the person I would be going to if I had a track that I thought was overlooked and should be included if one is sunsetted. I know, Catherine, you wanted to say something too, so I'll turn it over.
Yeah, no, and I'd love to hear also your more of your thoughts on the reporting question that Alex asked you. But yeah, I just wanted to also note that the legislation actually requires consultation for state executives to consult with the local jurisdictions in which a replacement tract would be located. So the thinking there, or the intent behind that, is to ensure that the local community wants that replacement or wants that designation, that it makes sense for them. Maybe the state executive identifies one, but it actually is across Water Street, or what the comment was in Selma, that actually would be better. And so the idea here, I think, is making sure that there is a level of consultation, so that if the state executive, if the governor's office is taking a look at communities that would be well suited for replacement tract, that they're getting that input. That would be really, really helpful in making sure it's the right one, or it's the right place. So that is actually a requirement in legislation.
Yeah, absolutely. And I think the key phrase is open and transparent process, so we know who's been consulted at the end of the day. But to go to Catherine's point, Alex, I would also love to hear your take on reporting requirements.
So I think it's a breath of fresh air that we've needed for a while, right? To actually understand. And I think it's been really interesting to watch the market backfill some of this question on reporting requirements, right? Like, you've got multiple states that have created parallel OZ incentives, but tied it to reporting, right? Where we've got limited data. You've got 2019 report that that pulled at least like what could be pulled from available data on existing OZ investment. And I think that even that report, which was comprehensive as you could get, it didn't pick up full on, market maturation from 2020 on, which is where I really think the market matured. And I just think, candidly, none of us know fully the scope of what's happening out there, right? So I think that as we're directing policy, and even as we're thinking about deploying the dynamism fund, right? Even as we're thinking about crafting the next set of rules around this policy, and particularly as we're thinking forward to, these deadlines talk about huge pieces in this legislation. Kicking the date out to 2028, dropping the 15% basis step up window from 7 years to 6 years. Those are all things that I think could create yet another surge of OZ investment, like I think those of us with funds saw at the end of last year. And so if all these are going down parallel tracks, right? If we have a dynamism fund heading down the track at the same time as we're having kind of these re-engaged community conversations because of that dynamism fund, at the same time as investors are having a renewed reason for getting engaged in this whole OZ conversation in the first place because of that new extended window, I think, and all that's informed by data that we now actually have on the program. I think that's something special that we've really never had before. We've never had that combination of things all happening at once before.
One other thing on the reporting requirements, again, so much of the opportunities and investment is going into real estate infrastructure. We're thematically a multifamily housing investor. We do place-based investing in infrastructure. So many of the reporting I would be doing in the next 3 years is all pro forma. It's all forecasting. And so to the extent that the reporting can accept and adjust a forecast, that's great. The forecast is not going to be what the actuals are. I think I saw a question on the Q&A that talked about new market tax credit, community benefits questions. When I fill those out, I filled them out a couple of times for different loan agreements we've done. They're just don't apply to many of the real estate investments. And in fact, there's some things that I think you would want to add to it that for real estate investment and for housing, et cetera, that dominates this particular investment space, that it may warrant a new or at least a modified approach from that. I'm not worried about the time it takes. It's not cumbersome to fill out a report. It's just, if it's not relevant, you're not going to know what to say.
Yeah, absolutely. Thank you guys both for your insights there. We have about 5 minutes left. I'm seeing a lot of questions in the Q&A box and the chat. And I just want to note that after we conclude this panel, I I think a lot of the questions are applicable to the next panel, just around specific provisions and what's next as we look ahead. So you're not being ignored. We're just saving them and answering them in some cases as we go along here. Catherine mentioned a few times during her presentation about the fund of funds provision and wanting to get your insights on how that could benefit the opportunity zones market, maybe even benefit the operating businesses side of the market. And I'm curious to hear Alex and Stephanie provide insights on fund of funds and what could change or what could be different if that was allowable.
Yeah, first of all, I think it's fantastic. There's three kind of practical reasons that I think fund of funds is great. One, the first is many high net worth individuals have set up a fund, but they want to, like, for example, when they're investing in us, if they want to get exposure to our entire portfolio, to come in and co-invest at every QOZB, it's just cumbersome. It's overly burdensome from a reporting standpoint, and all they're doing is coming in as an LP at the QOZB level with their own fund because they established it in order to shelter the gains and then give themselves some time to find the right investment. The second thing is, again, my investments are $8 to $15 million at a time. These are not large institutional investments. I'm not doing $300 million projects. We're doing $25 to $30 million projects, and having an institutional come in through a fund and give me a $20 million check is a lot more efficient to come into the fund and be dispersed as a feeder fund. So we think that's very, very efficient. And then thirdly, just from a reporting standpoint, you have all this long tail fractionalized funds. Having some consolidation to where the money is actually going, I think is highly beneficial for tracking what's happening. So it's those are the things that I think about kind of off the cuff. And I probably have 10 or 15 co-investors that, God, I wish I could have just brought them to the fund. We're a small team and the overhead is pretty burdensome to do that.
Totally agree. I mean, I've got, a deal now that this feeder fund would actually, that I'm almost having to do right now as a non-qualified deal because of the very unique way in which it was structured, and feeder fund would solve that challenge for us on a couple of deals. And then in general, I think to Stephanie's point, it significantly opens up the marketplace for folks like us that are doing smaller dollar value investments across a series of projects. So excited about that. I think of the two, I want all the stuff that's in here to go. I am very excited about the potential for having more folks take notice of this program, again, because of the deadline changes. I think that when you talk about like creating a larger funnel at the top of the program, the amount of traction that I think we could wind up getting in the investor marketplace by going back out and saying, hey, there's a new opportunity to get that 15% basis step up, even just as a marketing thing, it would be a very big deal.
Yeah. What is that? I guess kind of a thing I think about the fund of funds as well is the related party rules are somewhat murky in my mind right now with regard to the landowner selling, in the fund of funds. I think you do need to be careful if you're not trying to disrupt the related party rules, that you can't go into your own fund and then that fund come back through and show that it's not and hide from the related party transaction. There's some things there that I think bear some investigation, but would just caution around that.
Yeah, and when I think about the fund of funds structure, there's the operating business side of it, which I think it's helpful for that, but there's still some regulatory hurdles on operating business. But when it pertains to real estate, I think about some of the urban infill projects or smaller dollar projects that are going to have big impacts along main streets that otherwise wouldn't get funding because
they're too fractional, they're too small. Yeah,
exactly. Yep.
Yeah.
So I'm a
totally
big fan of that part of the legislation. Well,
Same.
We are right at 3:50, and I know we want to allow plenty of time for Q&A with Adam, but Alex and Stephanie want to thank you guys for making yourself available so immediately after the bill was introduced. And as always, great to get your insights and good to see you both.
Thanks, you guys. Thanks for all your work.
Yeah, thank you so much.